Hello everyone, and welcome back to the Web3 Daily. Let's dive into the latest market movements. The market action lately feels a bit like a game of red light, green light. The bulls and bears are locked in a stalemate, neither side willing to give an inch. Bitcoin is just hovering around that $110,000 mark, and the overall market volume has dipped. It's like everyone is holding their breath, waiting for the inflation data to come out of the US to see which way the wind will blow. Frankly, after last week's aggressive run-up, the market needed to cool its jets and take a breather, so a drop in trading activity is pretty normal. But here's an interesting piece of data. The total open interest in Bitcoin options has now surpassed futures contracts by $40 billion. That's a historic gap, and what does it tell us? It shows a massive increase in hedging activity. A lot of people are buying insurance for their positions, which is also a sign that the market is maturing. It's not the same old Wild West where everyone just went all in anymore. Today, let's tackle a topic that's been around the block but always seems to have a new angle to it: regulation in China. Recently, the governor of the central bank, Pan Gongsheng, gave another speech at the Financial Street Forum. It was mostly a rehash of the same old tune. They're going to continue cracking down on domestic virtual currency speculation, and he emphasized that all the policy documents from back in 2017 are still very much in effect. His concerns are the usual suspects: anti-money laundering, KYC, and the idea that virtual currencies, especially stablecoins, are creating loopholes in global financial regulation, becoming hotbeds for money laundering and illicit capital flight. But here's the most interesting part: the market's reaction. After this speech, the global market was completely unfazed. The prices of Bitcoin and Ethereum were rock solid. This is a stark contrast to a few years ago when this kind of news would have triggered an instant waterfall crash. So why the change? The answer is actually simple. Global players have long since accepted China's strict regulatory stance as a permanent fixture and have fully priced it in. To put it bluntly, the market's focus has shifted. It's no longer about is China in or out, but rather, how do we play the game now that China is out? And if you really analyze Governor Pan's words, you can see the strategy at play. On one hand, he talks about cracking down on virtual currencies, but on the other, he's all about promoting the digital yuan. This is a 1-2 punch. They're blocking the road for the private, decentralized cryptocurrencies that we're all involved in, while paving a superhighway for their own state-controlled, centralized digital yuan. The underlying logic is to replace anonymous, decentralized assets with a digital currency that the state can fully control, ultimately achieving stronger command over economic activity. What's even more fascinating is the subtle distinction in his phrasing. He talks about cracking down on domestic virtual currency speculation, but for overseas stablecoins, the term he uses is closely track and dynamically assess. Now that's something to chew on. Internally, stablecoins are seen as a channel for capital flight and must be strictly contained. But externally, they are keenly aware that USD-backed stablecoins like USDC and USDT are conquering the globe, essentially reinforcing the dominance of the US dollar in the digital age. From their perspective, this is a geopolitical threat. So you see, while the US, Japan, and Hong Kong are busy issuing licenses for stablecoins and trying to bring them into the regulated fold, China is doing the exact opposite, reiterating its ban. This is no longer just about financial regulation. It's more like a strategic statement to the world, a move on the grand chessboard for dominance in the future digital financial order. Okay, for our first major headline, let's turn our attention to India, another major nation with a historically ambiguous stance on cryptocurrency. But a court ruling there just yesterday could completely change the rules of the game. India's Madras High Court has issued a landmark decision, officially recognizing cryptocurrency as property under Indian law. This all started when an investor's XRP tokens were frozen on the Wazir X exchange following a cyber attack, and she sued to get her rightful assets back. The judge was crystal clear, stating that while cryptocurrency is intangible and not a currency in the strictest sense, it is a form of property that can be owned and enjoyed. It's more than just a string of code or information. This ruling provides an unprecedented level of legal clarity for the status of cryptocurrency in India. The implications for India's entire crypto industry are massive. From now on, there is a clear legal basis for all legal issues involving digital assets, whether it's for taxation, inheritance, or bankruptcy proceedings. The court also cited similar legal precedents from New Zealand, the UK, Singapore, and the United States, indicating that recognizing the property rights of crypto assets is a growing global judicial trend. It's fair to say this is a crucial step forward for crypto regulation in India, paving the way for future innovation and consumer protection. Now, Let's shift our focus from Washington to the Asia-Pacific region and take a look at Japan. We just discussed China's stance on stablecoins, but right next door in Japan, they're singing a completely different tune. Just yesterday, Japan officially launched its first fully compliant yen-pegged stablecoin, JPYC. This is a huge deal, not some small-time project. It's the very first product to be properly approved under Japan's own Revised Payment Services Act, which makes it a landmark event. Its reserve structure is rock solid, 100% backed by yen deposits and Japanese government bonds, which is their way of telling you this thing is absolutely secure and can be redeemed one-to-one for yen at any time. And to capture the market, they're coming out swinging with a killer promotion. 0 fees on issuance, redemption, and transfers. Their business model is to make money off the interest earned from the government bonds they hold in reserve. And they're not thinking small either. They plan to issue 10 trillion yen worth of the stablecoin over the next 3 years, which is about 66 billion US dollars. This is where the story gets bigger. Right now, the global stablecoin market is over 99% dominated by USD-pegged tokens. In other words, digital dollar hegemony. Japan's move is a strategic play on the grand chessboard. By creating their own sovereign-controlled, legally clear framework for stablecoins, they are building a non-dollar digital currency ecosystem. You could say this is the first shot fired in the battle against the overwhelming dominance of the dollar. The strategic significance behind this is far greater than its commercial value alone. Okay, this next piece of news is a true milestone for all of us who've been in the game for a while. In the past, if you wanted to invest, your choices were pretty much limited to Bitcoin and Ethereum. But that's all changing. The U.S. has just given the green light to a whole batch of spot ETFs for altcoins. Specifically, asset manager Bitwise's Solana staking ETF, ticker BSOL, is set to list on the New York Stock Exchange this Tuesday. At the same time, another firm, Canary Capital, is launching spot ETFs for Litecoin and HBAR, with tickers LTCC and HBR, respectively, also hitting the Nasdaq on Tuesday. The smooth rollout of these ETFs is thanks to the SEC recently streamlining its approval process. Now, companies just need to submit their final S1 filings, and they can go effective automatically after 20 days. No more waiting for individual approvals. What does this tell us? It shows that regulators have come to a realization: it's better to guide the flow than to block it, and they're establishing a standardized procedure to do just that. The significance of this is profound. It shatters the old paradigm where only Bitcoin and Ethereum were deemed worthy of the main stage. Now, assets like Solana, a high-performance public blockchain, Litecoin, a veteran payment network, and HBAR, an enterprise-focused technology, can all enter the portfolios of traditional institutions and retail investors through compliant ETF products. This is a massive expansion for the entire Web3 ecosystem. And once the floodgates are open, competition is sure to follow. Besides, the two firms already launching, giants like ProShares have also filed applications to create an index ETF that tracks 20 leading crypto assets. Bloomberg analysts are predicting that within a year, there could be over 200 active crypto ETF applications in the US market. Personally, I believe the launch of these altcoin ETFs signals a new level of understanding from institutional capital. If the Bitcoin ETF was traditional finance's acknowledgement of crypto's digital gold status, and the Ethereum ETF validated the value of smart contract platforms, then the arrival of ETFs for SOL, LTC, and others means that institutions are now starting to make more precise, targeted bets on the various subsectors within the broader Web3 landscape. They're moving beyond simply buying cryptocurrency as a monolithic concept and are beginning to construct portfolios based on specific investment themes, like high-speed blockchains or decentralized payments, much like how they approach tech stocks. This shift is poised to unlock a new wave of more sophisticated and substantial institutional capital for the market. For our next story, we're looking at another profound integration between traditional finance and the crypto world. Banking giant Citigroup has officially announced a partnership with Coinbase. These two titans aren't teaming up to launch some trading desk. Their goal is to develop digital asset payment capabilities for Citi's global institutional clients. My first reaction to this news was, this is what real adoption looks like. The first phase of their collaboration is aimed at solving a major headache for everyone in this space: the inefficiency of fiat on and off ramps. What they want to build is a system that allows institutional clients to seamlessly convert between fiat and crypto 24/7 without interruption. But that's just the appetizer. The real main course of this partnership is their explicitly stated goal to explore creating alternative fiat to on-chain stablecoin payout methods. Let me translate that for you. They want to directly integrate stablecoins into Citigroup's institutional payment and settlement systems. Just think about what that implies. It means that in the future, Citi's institutional clients could potentially use stablecoins for global, near, instantaneous, low-cost payments and settlements. This is a brilliant strategic move. For Citi, they're connecting their massive global payment network to Coinbase's crypto rails, essentially outsourcing the complex crypto tech to the experts while maintaining tight control over their core client relationships and compliance. And for Coinbase, partnering with a bank of Citi's caliber is like getting a golden ticket into the world's top financial circles, solidifying their position as the go-to partner for TradFi's entry into crypto. So, to be clear, this collaboration isn't about speculating on coins. It's about leveraging stable coins, blockchain's killer app, to upgrade the fundamental plumbing of the global financial system. That's the kind of thing that truly changes the game. And speaking of giants making their move, the big brother of the tech world, IBM, isn't just sitting on the sidelines anymore. Just yesterday, IBM officially launched a platform called the Digital Asset Haven. Just listen to that name, you can already feel the security. In simple terms, IBM has teamed up with a digital wallet provider called DFNs to create a one-stop-shop solution for top-tier institutions. We're talking major banks, financial firms, and even governments to manage their digital assets. The core selling point of this platform is one thing: stability. IBM is essentially taking its decades of enterprise-grade security expertise from the traditional finance world and porting it directly into the crypto space. They're throwing the whole kitchen sink at it: multi-party computation MPC, top-of-the-line hardware security modules, HSMs, and offline cold storage solutions. They've basically stacked every security buff imaginable. But the real significance of this isn't just about how impressive the technology is, it's about the three letters themselves: IBM. For the entire industry, this is a massive vote of confidence. Think about it. Why have the most conservative pools of capital, like pension funds and sovereign wealth funds, been hesitant to enter the market? It's because they're wary of the risks and uncertainty. Well, now, IBM, a trusted old friend they've worked with for decades, a name that represents stability and compliance, is personally stepping into the ring to offer them a safe entry point. And you have to admire the brilliance of the name: Digital Asset Haven. That word, haven, speaks directly to the deepest concerns of corporate boards and chief risk officers. So what IBM is playing here isn't a technology game, it's a psychological one. They're repackaging complex blockchain technology into a familiar, controllable enterprise IT solution. And that move, right there, could be the final, crucial step in paving the way for the largest and most conservative capital pools in the world to finally embrace digital assets. And for our final story today, this is one that honestly left me a bit stunned when I first saw it. I had to double check if I was reading it right. At a private party, Donald Trump dropped another bombshell, suggesting that cryptocurrency could potentially be used to solve America's staggering $35 trillion national debt. Yes, you heard that right, that astronomical figure. According to a leaked video, he said he'd write on a small note, $35 billion in cryptos, we have no debt. Now, he likely misspoke, saying billion instead of trillion. But that's not the point. The point is that he connected cryptocurrency and sovereign national debt in a way that has never been done before. Does that sound completely wild? From a purely financial and operational standpoint, it's pretty much impossible. But we can't just look at it from that angle. The real power of this statement lies in its narrative impact. As the President of the United States, he positioned an asset class born out of distrust for the traditional sovereign currency system as a potential cure for a sovereign debt crisis. In one fell swoop, he elevated the status of cryptocurrency from a mere financial investment to the level of national economic strategy. On a deeper level, this is a masterful piece of political communication. He cleverly merged the anti-establishment ethos of cryptocurrency with his own populist political narrative. The national debt, in the eyes of many Americans, is a symbol of the establishment's failure in Washington. And the cryptocurrency, especially Bitcoin, has a core story of being an outside solution that isn't controlled by governments or central banks. By linking the two, Trump is essentially telling his supporters and the entire crypto community, the thing you believe in is the key to fixing the mess created by the establishment. So, this is no longer a serious economic proposal. It's a powerful political symbol that has successfully pushed cryptocurrency to the center stage of American political gamesmanship. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day we sift through the noise to bring you the most important news in the Web3 world, the core information that's closest to the money. Our goal with these curated insights is to help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges in the description box below. These are special high rebate offers we've secured for our viewers, hopefully saving you some costs along the way. Let's all stay rational, move steadily, and get rich slowly together in the world of Web3. May all of your crypto assets grow steadily. We'll see you tomorrow.